All right.
Should work now.
Yeah. All right. So before we sort of get into the fun, just a little background of who we are. My name's Crosse. I'm a double major in accounting and finance. I'm a senior and I'll be graduating in December of this year.
My name is Tyron Lincoln. I've been part of the investment management team for 1 year now. My major is in finance and my minor is in business analytics.
I'm Brandon Michek. This is my first year with the team and last year with the team. I graduated in spring with my finance degree and then getting an information systems degree this spring. So.
And then I'm Caleb Tamman, first and last year at the fund as well. Graduate in May and then majors in finance.
I'm Richard Vang. I'm also just joined for this semester for the IMT team. Graduated in May 2023, and my focus is also finance and economics.
All right, so before we sort of get into the actual performance of the fund, just a few things to keep in mind. First one being the Fed has raised interest rates by 0.25 percentage points already thrice so far this year. And it seems to be that it might be the last hike that we expect, but there's no definitive confirmation on that. And then sort of just leading into that, the fact that interest rates have been sort of increasing. Companies specifically in the information technology sector, while they are going to see growth, it's likely that their growth is going to be a lot slower just because they're not going to be able to invest as maybe when interest rates are lower. And then the other point that we'd like to make also is the fact that the US national debt did hit their ceiling of $31.4 trillion just recently. With a proposal in the works potentially of raising it by another 1.5 trillion, although again, there's no definitive confirmation on that just yet. And then just lastly, Silicon Valley Bank, as we all know, did collapse in the last couple of weeks, and it was in fact the first bank run that took place since the financial crisis back in 2000.
So over the past year, I've been working with Dr. Stivers in creating a security selection model that students in Finance 475 can use to determine what stocks they pick for their semester-long projects. So the name of the model is the Brandon S. Michek Security Selection Model. So yeah, it has a ring to it.
Who named that?
So it will be a tool that does not inform investors on investment decisions. Rather, it's just going to help in the selection process and determining what stocks they will pitch to the board. It will be a live document integrated with FactSet, which will provide real-time data to that student to make solid decision-making at that point in time. I used R in Microsoft Excel, like 3,000 lines of code to run all my regressions, correlations, et cetera. And then I looked at 3,914 unique stocks, 14 million observations with 12 financial measures that value investors most care about, with 20 years of monthly data. And then I also looked at annual and monthly returns as well. So here's the prototype. So it's beautiful in its glory. So running the various regressions in R, I was able to get the estimate column that you see off towards the middle here, which I used the estimate to then assign weights in determining what value investing financial measure matters most in predicting future returns. So we can see here that price of sales had the highest weight, so it mattered the most. And then using this weight that it will utilize to calculate the composite scores to the right, sum it up to get an overall score. So this use case right here is Microsoft. So, and then higher the score, the better. And then I also looked at various percentiles in their average monthly returns. So starting out with the top 1% of composite scores, and then we can see in conjunction with the average monthly returns to the right.
And just to give an annual rundown, I'll be talking about the performance of the portfolio through the year. So if you look at the visual, our portfolio performed just under the benchmark S&P 500 with a standard deviation of around under 6% at 5.82%, an alpha return negative 0.10%, and a Sharpe ratio of negative 7%. Moving on to the diversification of our portfolio, we're heavily over-allocated in the healthcare, industrials, utilities, and communication services sector. We kind of messed up on this visual and we're having some problems mapping out the weights. So the communication services sector is a bit lower here when it should be higher. Our goal is to impose a 5% range from the benchmark to be within 5% or under 5%. And this helps us reduce the portfolio standard deviation, which helps us earn closer to the market return and gives us better diversification within the portfolio. Some of the downsides, however, are the limited market exposure, like missing out on potential opportunities and the opportunities missed out that might grant higher returns.
Up next, we have our allocation effect graph right here. Obviously, sectors that are over allocated and overperform compared to the benchmark will have positive percentages, and ones that are under allocated and underperform compared to the benchmark will also have positive. Obviously, the opposite if it is a negative percentage. So we can see first that financials and consumer discretionary both were overperformers over the past year, and communication services, information technology, and energy were all some of the lower ones over the last year. Moving on to total sector returns, this kind of gives us a little bit more information compared to the SPY benchmark where we're comparing it against. We see that the fund beat the benchmark very heavily. Again, consumer discretionary and consumer services, those are both highlighted at the top. And then we have the underperformers obviously towards the bottom, that being industrials and healthcare, both the biggest discrepancies compared to the benchmark. And this is confirmed in our next selection effect graph. Obviously, communication services and consumer discretionary. Again, what big performers during the last year. This is a trend that we'll continue to see as we then look at industrials, information technology, and healthcare that were also under the benchmark. Finally, we see our total effect, which is just a combination of our selection and allocation effect graphs you've just previously seen. This basically just confirms what we've already seen twice already. Consumer discretionary and consumer services overperforming, and industrials, healthcare, and information technology were underperformers for last year.
And sort of now get into some of the specifics as far as why some of those sectors performed better than others. As Tyron mentioned, consumer discretionary, consumer services, and utilities were by far our best three performing sectors. As far as the returns are concerned, consumer discretionary got us a 28% return, consumer services got us roughly a 13% return, and utilities got us a 10.5% return. As far as consumer discretionary is concerned, it was one of those sectors that investors went towards to provide balance to their portfolios in times of inflation during the last 12 months. Consumer services, although it is heavily affected due to inflation, it surprisingly did perform well. We got a 13% return on it. And then utilities as well as just known to be one of those more stability-based sectors that a lot of investors go towards, and that stability in that sector has been the driving force for it to perform well. As far as the worst performing sectors are concerned, that would include industrials, real estate, and healthcare. Industrials was down about 16%, real estate was down about 14.8%, and healthcare was down about 12%. Industrials is sort of really affected by the slowdown of the economy in the recent months. Real estate as well was highly affected due to the increase in interest rates that we have been seeing. And I think even the mortgage rate is sitting anywhere around 6 to 7% as we speak. And then as far as healthcare is concerned, just a shortage of workers and a demand in rising wages is really causing that sector to sort of go down. Then to sort of get into some of the best and worst performing stocks a little bit, the three best performing stocks out of the portfolio were Netflix, Starbucks, and SAP. Netflix provided us a return of 53.66%. Starbucks got us a 34% return roughly, and SAP got us 31% return roughly as well. Netflix sort of attributes that towards their subscriber growth. They saw a 7.7 million surge of subscribers in 2022 in comparison to 7.66 in 2021. Starbucks has just been doing well on their retail front, and they do actually plan on opening up 9,000 new locations in the next 3 years. They also have had a new CEO come in as of March 2023, and so it'll be interesting to see what his vision looks like for the company going forward. And then lastly, we finished with SAP, which did perform well over the last 12 months. The only sort of downside that didn't necessarily affect it as much was the fact that they did see a workforce reduction of about 3,000 jobs in the last few weeks.
And then moving on to our worst performers, we have Turtle Beach, Intel, and then CVS. Not too much of a weight to the fund there, but we can see pretty drastic negative returns. Turtle Beach has about 43% negative, Intel negative 36, and then CVS negative 26. For Turtle Beach, management attempted to sell the company, but they had no interested buyers. So that could kind of signal a downside there for investors. And then Intel is reducing its workforce and curtailing spending by roughly $10 billion by 2025. And then CVS management expects slower growth of 3 to 5% with lower sales growth and earnings growth. So looking ahead for the fund, obviously as inflation remains elevated, it's kind of slowly cooling down. The Fed has aggressively tightened monetary policy. So the short-term economic growth could be lower than expected. And then some key factors to keep in mind over the coming year are obviously the inflation's direction and then the Fed's policy responses towards inflation. We may want to consider allocating more towards consumer or defensive stocks, whether that be in consumer staples, utilities, or healthcare sectors. And then these are some of the presentations you guys will all see today. We have Google, Nexstar, Disney, Diamondback Energy, Arisa Networks, and General Mills. And then those are the respective weights of the Spellman fund compared to the benchmark. We have consumer defensive down there, just for, going off the recommendation on the previous slide. The fund has a mandate of plus or minus 5%. So we have a little wiggle room there.
That sort of concludes our presentation for today, and we'll take any questions that you guys have for us at this time.
Where does CVS fall? Is it healthcare? Is it consumer defensive? That was one of your worst performers. What bucket was that dragging down?
I think we had CVS in healthcare, I want to say.
Which cash do we have in the portfolio? Roughly
15,000.
15,000.
Would you guys want us to allocate that towards buying Turtle Beach and we could name it Eagle Beach? When it would just fund the whole company. That's a winner.
Dress beach.
Along those lines, when you reviewed the negative performers, was there anything that stood out that we should be aware of and consider potentially liquidating because of there's a significant risk here?
I personally think you could probably liquidate Turtle Beach. Kind of questionable even in the fund to begin with, I think. And then obviously just the negative returns there. I don't see much comeback there.
You say questionable being the fund, what's the reason?
I don't necessarily think Turtle Beach is a great stock, just because there's so many other competitors that are above them, such as like Sony or anything else.
So you're thinking stock specific, not necessarily the mandate of the fund allows it in or shouldn't allow it in.
And then the only other point I will potentially make in regards to this would be Intel might be another one to potentially look at, seeing as they're going through a massive workforce reduction as well. That's a company that over the last couple of years is sort of falling behind in comparison to their other competitors in terms of NVIDIA, things like that. And so their chips seem to be far superior in comparison to what Intel has been producing. And so that might be another stock that potentially is more.
What about on the other side, performance? Is there anything that you maybe in your research that might point you to, hey, this thing might have gotten ahead of itself. Let's do take some profits and invest elsewhere into other areas of the market that our fancy new asset allocation model built. Stock selection.
Yeah.
The name was so long, I can't remember.
Just start that up. Acronym.
Yeah.
Nothing. Okay, well, let me, okay, you got it. That's fine. Unless you got some.
Oh, I was personally thinking about Nexstar and I was looking at it from last semester. I feel like we've held it for a really long time. Had really large gains, but since I haven't looked at it very specifically, not really sure about how it's performed.
Have you guys run the portfolio through your? I guess ask the question, have you run it through your fancy new model to
Not
see
yet,
how they all score?
not yet. It's going to be hopefully introduced to students by next semester or sometime next academic year.
So I was kind of curious to see where the stock's rated in that model.
Fran, could you go back to your model slide?
Yep.
Oh, sorry, one more. That. So something gets identified as being in that top 1%. We could reasonably expect that you're gonna pick up 200 basis points compared to the middle. So from bottom 50%, it's 1.4. Is that the kind of the midpoint? The average return was about 1.4, or is it somewhere between the 1.4 and 0.78?
So these were just the percentiles that I looked and then just reflecting the average monthly returns of these. So these are what the percentiles that we looked at for my research, and then taking the percentiles and then calculating the means of the returns that way.
So if I only buy the top percentile, I'm going to beat the bottom percentile by 300 basis points, 3.3 versus 0.27.
Yes, I believe that's correct.
Versus the average. That's somewhere in between 1.4 and 0.78. If we're taking top 50, bottom 50 is almost 70 basis points between. So
Yeah.
is our average monthly return for all stocks, regardless of score, of the 3,914 that you did? The average monthly return is 1.09% or something like that. So we're paying up 220 basis points. You see where I'm,
Yeah,
that's a big monthly pickup.
Yeah.
If
so
it-
this is just based on like all the data that I populated from September, like 2002 to all the way up to like September of 30th, and then running the percentiles on this. So there's still a lot of time that has passed since I ran and extracted all the data from FactSet. So these might be slightly
He's
adjusted.
asking a much more specific question. So when you say the distribution, and it's at the 50th percentile, it's the median, right? Okay. So you have the median up there, and to our eyes, it looks like you have the median up there twice. But
So
the
I just
returns
looked
are
at
very
bottom
different.
and top. I just decided to choose bottom and top.
But the bottom should be
Smaller.
I see. So that's actually not the 50, it's not the 50th percentile, it's the average of the top 50%.
Yeah.
Got it.
Yeah.
Yeah.
So then the bottom, okay.
Okay, yeah, sorry.
So then those
I
are-
understand, right.
So so I think the average return is 2.09.
So it's very, it feels misleading because like
Yeah, 1 point.
it, as you read this going down, we think of this as a cumulative distribution, right? Top 1%, the top 5%, right? And so, okay, yeah, I would present this differently. That would lower that confusion.
We confuse easily.
I could confuse you more with what's presented in the model, but.
Your job is to make it less confusing.
Yeah.
The BM model needs to make it less confusing.
Yes,
So this is where, so Microsoft was the one that you showed, and that was at a score of 2,000 something.
Yep.
The average composite score was 1395. So where does that put this one? Is that the top 1 percentile?
I would have to look at that. I just picked this as a use case. On the right, I have like Excel formulas in there, and then like this one right here just sums it up based on that. Because we picked out this main model, and then there's another model for lead 5-year returns, so in future. So then that figure up there with the average composite score is just the average of the normalized composite score, and then the other models normalized composite score to get a total composite score for Microsoft.
So maybe where he's going is, here's a list of all these stocks. Which ones can we expect to outperform? Which ones can we expect to underperform? Because I think generally speaking, when the groups look at these, which one should we trim? Well, let's trim one of these 3 losers. When in reality, they're on sale now.
Yeah.
So should we be Because you might pop Intel in here and go, you know, that 35% decline is way overdone. We should be buying.
So you can put in the stocks into that ticker section right there, and then a simple refresh. And then it will give you everything in real time. Snap of the finger.
Can we look at the performance attribution again? And I'm gonna make a suggestion for somebody who doesn't see these often. An easier way for me to see this, it maybe in a quadrant graph where you've got overperform, underperform, and overweight, underweight, and combine those. Because I was having trouble following what pushed the results of the fund. So you obviously know it a lot better than I do, it makes sense, but if I could see why the fund performed the way it did because of its allocation, that might be an easier way to display that.
Well, that makes sense. Thank you for that.
So what he's saying specifically is that you were talking about two dimensions of data, but you're presenting one dimension of data, and that's part of the confusion, right? So if you think of a graph, it's gonna be able to present exact two dimensions.
Working the weights. Yep, I got you. And on a go forward, you gave us the fund relative to the S&P, and you gave us a little bit of what you think the economy is going to look like. Is either of those two a heavier decision-making tool for what we're about to hear? Are you going to alter the portfolio based on your economic forecast? Are you going to alter it because you need to adjust to the index, some combination of the both, or something I haven't mentioned?
I think it should definitely be a combination of the both, just because we have the plus and minus 5% mandate. And then obviously, I think we should consider just overall inflation in the Fed's